You know what stocks are, but what really are stocks? That is what we're going to be discussing in this video. This is day 2 of 100 Days of Finance, where the entire goal is to give you more personal finance education in 100 days than most people get in their entire life. As always, my name is Derek and I got my degree in finance, so you don't have to. Let's get right into the video. So first, we need to understand that there are really two types of companies: private companies and publicly traded companies. A private company cannot be bought or sold by you or I. There can still be multiple owners, and it can even be owned by another company. A good example of a huge private company is In-N-Out, or Tesla before it went public. See, most public companies start out as private companies. They go public through what is known as an IPO. And yes, I do have a video on that coming out in this series. But anyways, a private company does not sell stock to the public through an exchange. So unless you have some serious connections, we can cross that one out. So when we talk about stocks, we are usually talking about public companies. These are companies that have had an IPO, or initial public offering. These companies do sell stock to the general public. So now that we have that out of the way, what really is a stock? Well, at the most basic level, a stock represents a share of ownership in a company and a claim to that company's profits. So believe it or not, right now you are talking to the owner of Walmart. I know, I'm pretty awesome. Along with millions of other owners who also have at least one share of Walmart. Less awesome when you put it that way. So why would a successful company want to give away its rights to its profits anyway? Well, usually to raise capital to grow even bigger. It's also a way for the founders of the company to kind of cash out and spread risk. You see, when you own stock in a company, not only do you get to claim part of its profits, these profits are what are known as dividends, but there is also risk. When the company does well, the stock does well. But when the company does bad, the stock also performs bad. Not only that, but since the stock is traded by the public, like you or I, the stock price can fall victim to people's emotions. But luckily, that's usually only in the short term. In the long term, a stock's success or failure is determined by the success or failure of the business that it represents. That is why it is so important to invest in good quality companies. But why do people invest in stocks in the first place? Well, in a sense, when you invest, you are saying that you trust the leaders of those companies to be able to make your money grow better than you could have by yourself. And in a lot of instances, those leaders are experts in their field and or innovators. Now, when a company does well, you are entitled to part of its profit, proportionate to your ownership in that company. Let me give you an example. The Example company just had its IPO, and it sold 100 shares total for $10 each. Psst. This is known as market capitalization. And yes, I do have a video coming on that in this series as well. Anyways, 100 shares, $10 each. Let's say I'm a big baller and I bought 2 shares. Now let's say the following year the company does well and it makes a $500 profit. Pretty good. Now since I own 2 out of the 100 shares, I own 2% of the company. And I'm entitled to 2% of those profits. In this example, that is $10. Now the company can do 3 main things. It can give me all or a portion of that profit. This is again what's famously known as a dividend. And you guessed it, there is a video coming on that as well. Now this is what most established companies tend to do. Think Coca-Cola, been around forever. The second thing it can do is reinvest the money back into the business. This is usually what most high growth companies tend to do. Think Tesla. Relatively new, chooses to use all of that money to make the business continue to grow. And the third thing it can do is to buy back its own stock. This is what a company does when it believes its stock is undervalued. Now, all 3 are usually pretty good for me, the partial owner. I either get money sent to me as a check, or I see the stock price go up as the company reinvests its profits, or my percentage owned increases when the company buys back and destroys its own stock. Just remember, this is when a company makes money. If a company loses money, the stock price may very well go down. That is why diversification is so important. And yes, you guessed it, I have a video coming on that as well. So make sure to subscribe and turn on the bell notification so you don't miss any of the following videos in the 100 Days of Finance series. In tomorrow's video, we will be discussing what bonds are as we continue our journey of 100 Days of Finance. Again, my name is Derek and I got my degree in finance, so you don't have to. I love this stuff. It's been my passion for over a decade and I love being able to share that with you. I'll see you tomorrow.